In the modern economic hierarchy, the tech startup founder is treated like a rock star. The media feeds us a highly specific, intoxicating narrative. A brilliant coder drops out of college, raises millions of dollars in venture capital, builds a revolutionary app, and becomes an overnight billionaire before age 30. We look at these mega rounds of funding and immediately associate them with unimaginable wealth. When an article drops saying a founder just raised a $20 million Series A, the public assumes that founder's rich. But if you peek behind the pitch decks and audit the actual personal balance sheets of modern tech founders, you enter a parallel universe of extreme financial vulnerability, a world where having a paper net worth of $10 million means absolutely nothing when you are trying to pay rent, because in the brutal architecture of venture capital, funding is not a paycheck. It is a massive corporate mortgage. What if I told you that 90% of tech founders take a severe salary cut compared to their peers? What if their equity is heavily diluted and structured so that investors get paid before they do? And what if the tech startup founder is running a race they are statistically guaranteed to lose? Today, we are running a brutal financial audit on the tech startup ecosystem. We will strip away the PR hype of VC funding rounds, calculate the massive opportunity cost of skipping a traditional big tech career, expose the hidden trap of liquidation preferences, and map the real net return of the startup gamble. Let's find out why the founder's dream is often a financial trap. Let's destroy the biggest misconception about tech startups: the nature of venture capital. When a company raises $10 million, that cash does not belong to the founder. It goes directly onto the company's balance sheet to fund engineering talent, servers, marketing, and office space. In exchange for that cash, the founder signs a term sheet with a massive clause: liquidation preferences. In the post-zero interest rate policy era, venture capitalists write terms protecting their downside. A standard one-times liquidation preference means that if the company is sold, the investors must get their entire initial investment back before the founder sees a single dollar. Then comes the math of equity dilution. Every time a founder raises a new round of capital to survive, they sell off 15 to 25% of their company. By the time a startup reaches a Series C round, the founder's original 100% ownership has often shrunk down to just 15 to 20%. Think about how these two traps collide. If a company raises $25 million over 5 years and scales to a $30 million acquisition, which looks like a massive win on paper, the liquidation preference dictates that the VCs take their $25 million back first. The remaining $5 million is split among co-founders, employees, and taxes. After half a decade of 80-hour work weeks, the founder walks away with next to nothing. According to data tracking the startup lifecycle, close to 90% of tech startups completely fail. Even among those that raise institutional seed funding, fewer than 10% ever achieve a successful acquisition, or IPO. The founder is taking on near total financial risk for an equity piece that will most likely be worth zero. To truly understand the financial trap of being a founder, we have to look at the alternative, the big tech opportunity cost. While a founder is burning their 20s trying to scale an idea, their peers who took corporate jobs in big tech are quietly building massive liquid fortunes. An experienced senior software engineer or product manager at a FAANG company regularly commands total compensation packages ranging from $300,000 to over $500,000 a year. Crucially, a massive portion of this pay is delivered in liquid RSUs, publicly traded stock that can be sold for real cash every single quarter. Now look at the startup founder. VCs do not allow founders to pay themselves market rate corporate salaries out of investment capital. They want the founder hungry. Now, to be fair, Series A founder salaries have been rising. Recent data shows averages around $200,000 at the Series A stage, with some pushing higher in expensive markets. But this is still dramatically below the $300,000 to $500,000 in total compensation those same founders could command at an established tech company. And it's still capped by investors who want the founder's incentives aligned with the company's survival, not their personal bank account. The gap between what a founder earns and what they could earn is the hidden tax of the startup dream. Let's do the cumulative math over 5 years. The big tech employee pulls in close to $1.8 million in liquid spendable wealth, which they can invest in real estate or index funds. The founder brings home $500,000 in total pre-tax salary, barely covering their cost of living, while holding $8 million in paper equity, shares in a private company that cannot be traded, sold, or used to buy a sandwich. The founder is essentially trading guaranteed high-tier liquid wealth for an illiquid lottery ticket. They are subsidizing the company's growth by taking a massive personal salary discount, bearing an enormous financial opportunity cost every single day. This brings us to the psychological prison of the tech founder, the illiquidity lock. Even if the startup is highly successful and its valuation shoots up into the tens of millions, the founder remains asset-rich but entirely cash-poor. A founder cannot just sell a fraction of their shares to buy a house or diversify their portfolio. Board members and investors explicitly restrict secondary market sales to keep the founder fully locked into the grind. If a founder tries to cash out too early, it signals a lack of confidence to the market, which can crater the company's reputation. This means the founder's entire net worth is trapped in a single, highly volatile basket. In the fast-moving tech landscape, market conditions change overnight. A company that was a darling on paper 2 years ago can be crushed by an AI breakthrough from a competitor or a macroeconomic contraction, turning tens of millions in paper equity into completely worthless digital ink before the founder ever gets a chance to liquidate. The lifestyle cost is just as severe. Founders bear the moral and legal liabilities of payroll. They manage investor pressure, look after employee livelihoods, and face the constant threat of a cash runway running out. They live in a state of permanent high cortisol stress, knowing that if the company goes under, their primary professional achievement vanishes alongside their primary financial asset. To see the raw truth of the startup gamble, let's run the definitive, real-world comparison. Let's look at the financial reality of 100 founders who start a venture-backed company versus 100 professionals who stay on the corporate big tech path over a 7-year period. Out of 100 founders who set out into the ecosystem, 90 will exit with absolutely nothing for their equity, having earned only their capped below-market salary for years. 9 will achieve a modest exit where, after liquidation preferences and dilution are paid out, they walk away with a small cash buffer of $50,000 to $200,000. Only one founder out of 100 will hit the legendary, life-altering unicorn payout. Now look at the 100 professionals who took the corporate big tech route. Assuming standard career progression to a senior or staff level over those same 7 years, 100 out of 100 will have earned between $2.5 million and $3.5 million in highly liquid, fully settled, diversified wealth. Statistically, the corporate worker achieves a far superior financial outcome with near zero personal liability, zero capital risk, and standard 40-hour work weeks. The startup path is a systemic financial trap disguised as a wealth vehicle. Does this mean you should never start a tech company? Absolutely not, but you must do it for the right reasons. If you do it solely for the paycheck, the economic data says you are making a massive mathematical error. The real return of being a founder isn't found in your bank account. It's found in the rare, chaotic privilege of bringing a new product into the world and steering your own ship. But if you're chasing the money, the corporate cubicle is where the real fortune is made. Let me know your thoughts in the comments below. Would you take the founder's gamble or the corporate guarantee? Next time, we're auditing what teachers really earn after years of debt. Subscribe so you don't miss it.